Today, we're going to talk about real estate debt funds, and we're going to go deep in the weeds. This is almost going to be a masterclass on how to evaluate a real estate debt fund, how to do due diligence on it, trying to determine which type of managers, which strategies you want to invest in, where the red flags are. Because if you think about it, real estate debt investments, it's a negative art. You need to make sure you're investing in loan portfolios that don't blow up, that don't lose money, because you're not going to hit 20 IRRs here. You're not going to hit it out of the park. You're not going to have surprises to the upside. You have the stated interest rate. Maybe you have some points. You can get a little bit higher, but for the most part, you're trying to make sure that number doesn't go down, right? You don't have a bunch of loans in the portfolio default. So we need to focus on due diligence and making smart investments with managers that know what they're doing. And so we're going to go deep in the weeds here in this video on exactly how you might go about doing that. All right, we're going to use some slides here just to help. We're not going to make this a long, boring slide presentation, hopefully, but we're going to fire through some of these visuals. Real estate debt fund, I think most of you know what exactly that is. It's just a pool of loans that are all supporting real estate. They're all mortgages on commercial real estate properties. The majority of these are multifamily or senior housing or industrial. So a wide range of diversified commercial property as opposed to single family homes. And there's three types of debt. There's senior debt. That's like a senior mortgage, right? That's like your home mortgage. It's a first lien. It's the most protected lien on a property. Mezzanine debt is a little bit like equity. It's this hybrid investment that has higher interest rates because it has higher default probability versus the first loan. And then bridge loans, this is like a hard money loan where you're trying to bridge the gap from the construction financing to the ultimate permanent financing, right? It's a bridge to that permanent financing. And this is going to have really high interest rates and is typically going to be shorter term loans. It's for properties that are in transition. Lots of times it's some sort of construction project. But the common traits here, you're going to have these all be income focused. You're going to get monthly payments from all of these debt investments. They're going to be collateralized by the real estate, right? That means protected by the real estate. You can go after the asset if there's a default. They're going to have lower volatility than equity. Makes sense. It's debt. It's a lower risk investment. They're going to have a defined maturity term. So it's not going to be this 10-year type of investment. Usually it's 2, maybe 5 years is the term on these investments. It's typically fairly short term. Oftentimes the loans are made for 2 to 5 years. And we talked about this last point, you have priority over the equity. Okay, so what are the major things you're going to be looking for when evaluating these debt fund managers? Obviously, number one, track record. You want to see people that have done this before, they've done well, they've generated great returns, and ideally over multiple cycles. You don't want to just invest with somebody that's done well in boom times. You want somebody that's seen the difficult times where they've had to scrap and claw to get back the keys to the property and then sell it and recoup their loan balance. You want pros. Number two, strategy. Okay, what is the focus of this investment fund, this real estate debt investment fund? Is it on multifamily? Is it on single family housing rehabs? Is it focused in a geography? Do they focus in one state or one market, or is it nationwide? And of course, the types of loans that we just went over, is that their niche? Do they have a sufficient portfolio size? Is this 10 loan portfolio? No, hopefully you want a lot of loans in the portfolio because once again, this is a negative type of investment. We're trying to protect the downside. We're not trying to concentrate risk here. Speaking of risk, does the manager have risk controls in place? What are they underwriting to? Are they putting on too much leverage on the back of these loans at the portfolio level? That's a big thing for debt funds. Terms and fees, pretty self-explanatory. You got to know those. And of course, what are their projections moving forward? We know what happened in the past. We're in a different environment today. What do they think they can achieve from a yield standpoint, the money that's coming to you in monthly distributions, those debt payments? What is their historical loss ratio? How many loans have defaulted? And what is their recovery rate? If they do have a default, what percentage of the loan balance do they typically recover? The great managers in this space often recover almost 100% of those loans on the properties that they get the keys back and they end up having to sell to recoup the loan balance. Okay, let's dive a little deeper on the really important items here, namely, number one, track record. How long have they been in real estate? How long have they been doing this exact strategy? What's their experience through different market cycles? Is this their first fund? Is this their 10th? Ideally, it's not their first, of course. Has the team been together a while? Are they tenured? Do the principals have skin in the game? Have they ponied up some cash? Do they really believe in this fund and they've invested alongside of it? A surprising amount of funds have zero from the principals. And so even a little is a good sign, but obviously the more the better. And this last point, did they invest in the fund alongside you? Okay, deeper dive into loan types. We talked about senior, mezzanine, bridge. We talked about those three flavors. But is the interest rate floating or is it fixed? Cap on the loan to value that they can push on their individual loans. This will be spelled out in the docs. Typically, we'll have a roof. They're not going to go over 80%. Maybe it's 70% loan to value. Maybe it's 75% loan to value. Property focus, it's pretty self explanatory, but ideally, you want to see them focusing on a couple of asset types. Generally speaking, they're not going to be great at underwriting every single real estate asset class. So if you have a lender that's talking about 10 different types of properties, maybe you want to pass. And then this market position, what's their edge? What are they leaning into to generate these great returns without a lot of risk? Is that their deal flow? Is that their sourcing channels, the relationships they have with brokers, with sponsors? I think of this section as the story component. What is the story that has generated these great, reliable returns? And now, once you have that understanding of the strategy and the players, let's dive into the actual portfolio metrics. Why is this portfolio diversified? Why is it robust? And in order to determine that, you got to get into the numbers. You got to decide whether or not it's meeting your standards. And to start, we know we want a lot of loans in this portfolio, ideally a lot more than 30 loans. We want to see not, and hopefully there isn't one giant loan in this portfolio. So the max single loan. So you want to see the number one loan in this portfolio being less than 10% ideally. On the point of geographic diversification, you wouldn't want all these loans to be on one little island just offside. You wouldn't want all these loans to be on one little street corner, right? Where they owned every single property. They owned the mortgage on every property. You want it spaced out, ideally in a bunch of different MSAs. So you're not tied to one economy. This next point on property type mix, I actually think you can go for one property type, but then you might want to diversify across different managers. If you have somebody who's very good at just multifamily apartment loans, that's fine. But then I would sprinkle in some other lenders that have different asset class specialties. So you get portfolio diversification yourself, not in that individual loan. And then this last point is often overlooked. You don't want the lender to only be making loans to one sponsor. You want them to be making loans to a bunch of different underlying property owners. And so the consistent theme here is no single point of failure. Okay. And on the right side is the more technical portfolio metrics that you're going to look at. The weighted average LTV, loan to value, debt service coverage ratios, how much margin of error do the underlying borrowers have before they're in default on the loan? Next point, are these good borrowers? Are these professional firms? Are these professional firms with big teams and good track records on their own? Are the properties in good condition? Are they in good markets? Or are these random properties in the middle of nowhere? And then these last three bullet points are about the quality of the individual loans. And you're going to get some of these metrics from the sponsors, from the loan fund itself. Sometimes they'll include this in the deck. Sometimes they'll include this in the presentation and in their war room. Other times it's going to be on a phone call. You're going to have to try to get this out of them verbally. And I put all of these in that same category. You're not going to get everything that you want on all of these questions from each individual loan, from each individual debt fund that you're going to come across or analyze. It is a wide range of information that they share with their prospective investors. It'd be nice if this was uniform, but it is not. So this is the range of questions you might ask for risk analysis and their underwriting standards, but just know you're probably not going to get all of this. So there's a little bit of art to diligence in any analysis of a real estate debt fund. But here's the list. Pause it if you want to dive deeper. Okay, speaking of diving deeper, this is the loan level due diligence that you want to see the managers doing on each individual loan that they're making. This is what would go into a war room that they would have on their company's servers that would have every single possible file here on the individual property, their borrowers, the third-party reports on the property. They're just going to have all these because you want to invest with lenders that are very diligent. They're very detailed, that check all the boxes. If you ever gotten a loan on your own for a piece of property, you know how painful the experience is. Well, you want whoever you're investing with to be that diligent, to be that tedious with their underlying borrowers, because this is how you protect the investors when you're making a loan. Okay, now on to the investment side, because there's the underlying loans and there is the fund level documents and terms that you have to agree to with any individual debt investment, because the sponsor's not going to do this for free, right? They're going to charge a management fee. They're going to charge a performance fee that oftentimes is after you've gotten a minimum level return. That's the preferred return. which usually is 6 to 8% is the preferred return. Then once you've gotten that, then you start splitting the profits with the sponsor above that. And that split might be anywhere from 15 to 20% of the profits going to the fund manager. You're still getting the lion's share in addition to that 6 or 8% preferred return that you've already gotten. And then on the bottom here are some of the more nuanced terms in each of these loan documents. In each of these fund documents, how long can they keep the fund going? Many of these funds are evergreen in nature. They're very long term. They're an all weather type of strategy, right? Because you're investing in debt. It's not as volatile. You don't have to be as opportunistic about when you put money in and when you exit. Normally, you can make a debt investment with a good sponsor, and they're just constantly recycling these loans every 2 to 5 years. And you, as the limited partner, continue to get your loan payments. But the big one here is, what is the redemption process? When can I get liquidity if I want to exit, say, in year 3 or 5? Okay, how do you judge the performance of these debt funds? How do you compare one fund versus the next? There's going to be the IRR. That's basically the total return, which is going to be a component of the yield, that payment that's coming to you, most of the time monthly, sometimes quarterly. A little bit of potential appreciation above that from maybe some points that they made on the loans. Maybe they were able to make a loan, purchase a loan at a discount, and then when it pays off above, and then when it pays off at par, which is another way of saying 100%, and there's some appreciation in that particular loan. And so we think of that as a little boost in the returns, but we mostly focus on that recurring payment that's coming to us because it is a loan payment. Okay, so more fund due diligence is at the fund level, not the individual loan level. You may or may not get all of these documents, just like we talked about before. These could be in the war room. You're definitely going to get a PPM, a limited partnership agreement, LPA, and the subscription agreement. Those are all the documents you're going to need to sign to formalize your investment. If they're a large fund, they'll probably have audited financials that you can access in the war room, or at least you know that there is an auditor involved. It's probably from a firm that you heard of if it is, once again, a large debt fund. Sometimes you'll get to see some example loans, maybe some case studies, maybe a loan tape, which is just an Excel file that has all the loan detail on it. And then on the right side here, this is if you are making a giant investment. This is really only applicable if you're writing a $5-10 million check and you're going to get deep in the weeds on their governance structure. So this isn't if you were writing a $100,000, $250,000 check. Okay, red flags. What should give you pause and a little bit of concern if you come across these? Number one, high concentration is pretty obvious. Like they have 5 loans and they're all with one sponsor. Well, that's a double whammy. 2, they're really pushing LTV. You wouldn't believe it, but I've seen plenty of them that push leverage to that level in order to try to juice the IRRs. The lack of transparency, if it's literally just a PowerPoint deck that was kind of thrown together with some slides and it's got a trust me vibe to it, run the other way. Excessive fees. If they're taking the lion's share of the fees on a debt fund, when we know we're not going to have giant, huge home run type of return, so that's a problem. Key person red flag is just if it's a one-man shop. This person doesn't have a team or any real systems or protections in place. Okay, and the last one I'll touch on this slide is key person. You want to invest with a team, ideally. You want to have layers of protection. You don't want to be dependent on one individual. Okay, to tie it all together, let's make sure we're evaluating the manager's experience, their track record through multiple cycles, ideally. Let's understand the strategy that they're implementing. What type of markets are they focusing on? What type of investment properties are they good at? What types of risks are they taking? Are they very focused? And are the actual loans aligned with that strategy that they're telling you? And 3 here, you want to think about how diversified this thing really is, this fund, and what is the quality of the loans that they're making and the borrowers that they're lending to. 4, how rigorous is their underwriting, their documentation, and their protections? Do they have an engineering type of mindset to this fund with all their ducks in a row, or does it seem a little too casual? Because that's what you want to avoid in a debt type of investment. And then 5, make sure you understand the fees. How are they getting paid? What is your net return likely to be if the loans pay off at par? And does that structure feel fair to you? Is that market compared to other debt funds? And then on this last point, if you're writing a multi-million-dollar check, you're going to want to ask more questions that go a little bit deeper, but flex this point up and down based on how much actual exposure you have with your portfolio and the size of the check that you're writing. All right, so that was a super deep dive on real estate debt investing. And so if you like this information, there's more resources down below. Just click on the link and we'll reach out to you. All right, thanks for watching.